Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, October 15th, 2024. Hope you're having a fantastical day out there in the interwebs. It's another nice day here in Colorado. The cold weather won't be here till the weekend, which I'm hoping it holds off till Sunday because I have a comedy show I'm going to on Saturday evening, and it's outdoors, so I really don't want to freeze. And it's the first recording of Robbie the Fire Bernstein's I'm not sure what he's calling this show, but he's filming it live, so very exciting. So if you're a fan of Robbie's, go check it out. Anyways, all right. Well, before we jump into today's numbers, if you, there we are, up there. If you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All righty, let's get into today's markets. Dow Jones was down 0.75%, 324 points, closed at 42,740. S&P 500 down 0.71%, 41 points, closed at 58,18. NASDAQ down 0.98%, 180 points, closed at 18,322. The VIX was up 4.77% today. It's at 2064. Let's see here. Canada down 0.13%, Brazil down 0.19%, and Mexico up 0.64%. Let's see here. Over in Europe, Germany was up 0.06, so basically flat. The UK down 0.52, France down 1.05%, the Netherlands down 2.52%, Spain up 0.67, Italy down 0.29, Switzerland down 0.17, Portugal down 0.29. Russian exchange is both green again today. The MOEX up 1.07, RTSI up 0.12. And the overnights, the Nikkei in Japan was up 0.87%, Australia up 0.79%, New Zealand up 0.64%. In China, a bit of a reversal from yesterday. The Shanghai was down 2.53%, same with the Shenzhen component. China 50 was down 2.78%, DJ Shanghai down 2.38%, Hang Seng down 3.67%, and the Taiwan weighted when it closed on the 14th was up 0.32%. All right. So those are the markets for today. Awesome news. All righty, let's get into the market recap. Wall Street weighed by tech weakness. Oil extends its slide. U.S. stocks fell on Tuesday, with global markets also declining, driven by weaker than expected sales forecasts from chipmaker ASML, which weighed heavily on the tech sector. The three major U.S. indexes, S&P 500, Dow, and NASDAQ, opened lower, reversing Monday's gains as tech stocks took a hit. Although Goldman Sachs, Citigroup, and Bank of America posted solid earnings, disappointing results from United Health and J&J dampened investor sentiment in healthcare. ASML's weak third-quarter bookings and sales forecast set a negative tone for the broader tech sector. Rob Hawthorne of U.S. Bank Wealth Management noted that the U.S. market's tech-heavy composition made it particularly susceptible to these declines, while soft global economic data added to these concerns. Energy stocks also struggled, with oil prices hitting a near 2-week low. Oh my God, 2 weeks. As supply fears linked to the Middle East tensions eased. Reports indicated that Israel would likely avoid targeting Iranian oil assets, and both OPEC and the International Energy Agency lowered demand forecasts, citing economic softness in China. Brent and U.S. crude prices fell over 4%, which, according to Tim Grisky of Ingalls and Snyder, could have a disinflationary effect, benefiting the broader economy by easing cost pressures. In the bond market, U.S. Treasury yields dipped, with the 10-year 10-year yield falling to 4.036% following weak manufacturing data from the New York Federal Reserve. The dollar remained relatively stable against global currencies as investors anticipated potential modest rate cuts from the Federal Reserve. Gold prices rose, gaining from the dollar's slight weakness as spot gold reached $2,664 an ounce. The European stock markets also saw their largest drop in over 2 weeks, led by tech sector losses, while investors await the European Central Bank's upcoming rate decision. All right, so that's everything there. There was something that caught my eye, but it escaped me now that we're at the end of the article. So I don't remember what I was going to say, so I guess we'll move on. Fair enough. If I think about it, I'll bring it back up. All right, next article from Zero Hedge. Stagflation odds jump in latest New York Fed survey as inflation expectations rise. Delinquency fears hit a 4-year high. Concerns over inflation have resurged as the Fed's aggressive rate cuts appear to be spurring a potential second wave of galloping inflation. That is a new term. I have not seen that before. Well, let's Google this and see what galloping inflation means. The galloping inflation definition is galloping inflation is one that develops at a rapid pace, dual or triple digit annual rates, perhaps only for a brief period. Okay. Again, I've been doing this for 18 years. I've never heard that term before. All right, jumping back in recently, Deutsche Bank's Jim Reed noted that the U.S. 5-year inflation swaps saw their largest increase since early 2023, signaling renewed inflation worries. This shift follows the Fed's 50 basis point cut, which aimed to bolster the economy ahead of the November election, but coincided with rising geopolitical risks, an upswing in oil prices, robust U.S. jobs data, and a surprise uptick in CPI. The Fed's recent actions appear contradictory given current economic conditions. Stock prices and home values are at record highs. Wage inflation is close to 5%, and consumer inflation expectations are creeping back up. A survey from the New York Fed showed that inflation expectations increased for 3 and 5 year time horizons, with short-term expectations steady but heavily influenced by gas prices. In tandem with rising inflation, the outlook for consumer finances is deteriorating. The survey highlighted an increase in anticipated debt delinquency rates and a growing divide in economic well-being, with many households lacking stock market exposure and facing mounting debt. Concerns over stagflation, rising inflation, coupled with slow economic growth, are increasingly prevalent. The survey also indicated a dip in expectations for household income and spending growth, reinforcing stagflation fears. Consumer sentiment towards the labor market has slightly improved, with a marginal increase in the perceived probability of voluntary job changes and finding employment. However, expectations for savings interest rates and government debt growth reveal consumer uncertainty about future economic conditions. This snapshot suggests that the Fed's easing measures have unintended consequences, potentially fueling inflation without achieving broader economic relief. No, the Fed would do something that didn't help the average person? Shocking, I know. They only care about big business and Wall Street and the government. All right, last up, another article from Zero Hedge. It's titled Rickards. This is What Will Destroy the Dollar, authored by James Rickards of dailyreckoning.com. So let's see what he thinks is going to happen to the dollar. All right, Janet Yellen's recent speech addressed risks in the banking system and U.S. Treasury debt, but she also hinted at potential election turmoil linked to Donald Trump, suggesting his actions could destabilize the financial system. Like he wasn't president 4 years ago? I mean, seriously. This aligns with the Biden administration's all-of-government approach, using every department to support its agenda. Yellen's commentary also subtly tied Trump to threats against the financial system and rule of law. All these people should be rounded up and sent to Gitmo. Rickards criticizes Yellen's approach, particularly her controversial attempt to use $300 billion of Russian-held Treasury securities for a Ukraine loan. He argues that this action, seen as theft, has spurred BRICS nations, Brazil, Russia, India, China, and South Africa, and the Global South to explore alternative currencies, challenging the U.S. dollar's dominance. At an upcoming BRICS summit, further steps towards a currency union will be discussed, signaling a move away from reliance on the dollar. Although a BRICS currency won't replace the dollar overnight, Rickards notes that it's advancing as a potential payment currency supported by a secure digital infrastructure and a broader membership. Moving to a reserve currency status would require a robust bond market and legal infrastructure, which BRICS lacks. However, distrust in U.S. fiscal policy has led nations to increase their gold reserves as a hedge against dollar dependence. Gold's rising value reflects this shift, as it remains immune to sanctions and seizures. In Rickards' view, Yellen's policies and politicization of the Treasury may hasten the dollar's decline, prompting countries to seek alternatives, undermining long-term U.S. economic stability and trust in the Treasury. Yeah, the idiots in Washington will burn it down just to stay in power. So, I mean, I don't care. Let D.C., personally, I take all those people out of there, send them to Gitmo. And then I'd raise DC to the ground, just flatten it. Anyways, maybe turn it into like a welfare community. Well, it already is a welfare community, but where we just put a fence and maybe bring the people back from Gitmo and then just toss food over the fence for them. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there, so feel free to give me a buzz. All right. Well, hope everyone has a wonderful evening, and I'll talk to all y'all again next time. Adios.